Nothing like a couple of middle-aged dads talking about Estee Lauder.
Look, we both get the receipts from Aveda and Mac and everywhere else we go. We know people who are buying them, so at least we can talk about it in that way.
That's a very good point. That's a very good point. I'm Jason Hall. Got Tyler Crow here with me. Estee Lauder just reported earnings, and we've done prior videos looking at Estee Lauder and how the business's focus on China really had been a big pain point, not had been a serious pain point for the stock. But we just got another earnings release, and management said some things, and it looks like they're doing some things, Tyler, that I think you like. However, still not sure about valuation. You ready to go through this?
We just got done talking about renewables and natural gas pipelines. So naturally, I want to talk about skin cream and shampoo. So let's go.
Logical next video to make. Okay, we're going to do that. Before we do, though, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out our link after this video. Okay, Tyler. So again, not to rehash too much here, but you're a shareholder. You're an Estee Lauder shareholder. And also you're somebody that has lived internationally for a number of years. You have an interesting perspective about looking for companies that are trying to build beachheads and establish themselves in international markets where there's lots of opportunity. And it seemed like Estee Lauder was onto something for a while with China. The story of China's middle class expanding. There's over 500 million middle class in China now, and that number is expected to continue to grow. Two kind of diametrically opposing things can be true at the same time. Some demographic tailwind that looks good, but there's also demographic tailwind and structural problems that look horrible. What's going on? What did Estee Lauder report, and what are they doing to adjust to this new reality?
Yeah, I went through the conference call transcript, and so I'm not going to give the most precise numbers here, but just to give an idea, what we've been talking about previously is Estee Lauder really charged hard, like you said, into China, particularly with skincare products for China. And most of the Asia Pacific region is a much stronger sales vertical for them than perfumes, which tends to be a little bit more on the Europe, Middle East, and Africa segment of the business. But basically, one of the things that they had noted was that it's Asia Pacific, specifically China, and also its international travel segment, which for those of you who aren't necessarily familiar, Estee Lauder has really put a beachhead on basically going into duty-free stores. If anybody's been to very large international terminals as of late, you're going to see these super deluxe, like very luxurious, very clean display cases for a lot of fragrances, perfumes, skincares, things like that. And this is deliberate because if you are a upper to middle class to upper middle class business and you want to access the global upper and middle class, the place to be is airports, because the entire upper middle class of the world, no, that doesn't matter if you live in the United States or if you live in Angola, you're probably going through an international terminal airport. However, that has been a considerable weak point. Number one, because, like we said, weakness in China. And as a result, there's just been some general weakness with travel for a lot of places outside the United States in general. We've seen some international conflicts have played into this. We're seeing less international travel because of the Russia-Ukraine conflict. We're also starting to see that pop up because of what's going on in Israel right now, between Israel and in the Gaza Strip. So there's a lot going on that is affecting international travel.
It's significant enough. I'm going to pull up the earnings release. This is the second sentence in the earnings release. Organic net sales declined 11% primarily by expected pressures, company's Asia travel retail business, as well as incremental headwinds from a slower than expected recovery of overall prestige beauty in mainland China.
Yes, this is overall. For the entire company, its organic sales declined 11% just from those two particular segments. And if you look in the conference call, those two particular segments saw year-over-year organic sales drop almost 50%. And so it gives you an idea of how much this really has been impacting the company over the past couple of years. And there's a lot of questions as to whether or not, like some of the things you alluded to earlier on, how much longer this is going to continue. We continue to get a lot of stories with property developers in China going default, and there's a lot of stagnation in China as of late in terms of economic growth has been declining. Oil exports of them, they're at some of the lowest they've been in a long time, which is typically a sign of declining demand. And so there's just a lot going on in that particular part of the business. So what was interesting about what management talked about. And they're basically saying, how do we get this right? Because this obviously isn't good. And the thing
Well,
that,
first of all, and again, this was from the release. They said expected, right? This isn't a surprise. This didn't come out of nowhere. So management's been working on adapting its business to this for some time, and this is what they're actually doing now.
it was a very long 4 or 5 point plan. I'm not going to get through all of it, but let's just distill it down to what I saw was we want to just continue building on the things that are working right now. We want to build basically strength on strength and doubling down on the places where it actually is seeing some nice gains. It wants to double back down in the North America market. So probably you're going to see a lot more of a push of perhaps taking some of the brands that Estee Lauder has that are a little bit more popular in other places and try to bring them into the United States. I haven't been to the US in a while, but I know that in Europe and the Europe, Middle East, Africa area, Gel Malone has been one of their better selling products. I wouldn't be surprised if you see that sort of product coming across the shores. So think movements like that, reinforcing in America, reinforcing, like I said, fragrances in Europe, and basically doing a lot of strength on strength where things are working and not trying to double down in China and trying to win China as if it's a place that they have to win. They're like, no, we want to focus on price because we are a luxury sort of item. Like I said, if anybody's gotten a bill for anything involving Estee Lauder, it's probably pretty high relative to other commodity products in this space.
So if you look at some key metrics, Estee Lauder's gross margins have been eroding for 5 years. And I think part of that was the company may have started focusing a little more on price as a strategy to try to beachhead maybe in some of these markets. And when you're a premium brand, you can't get caught up in those battles. And then you factor in the recent sales declines that it's dealing with. The result gets really heavy when you drop from high 70s gross margins and then your operating margins start to drop as well from the 20s. It absolutely guts your profits. And that's what's happened. You know, when this falls and revenue starts to come down, these come down even faster. That's the decline. That's the concerning decline the management's trying to fix.
Yeah. So if you think about this sort of industry, the actual ingredients in the manufacturing of a product is not that expensive. Basically, all of your expenses are built into the brand. And when that is the case, everything comes down to your SG&A budget, your sales general and accounting budget, marketing, all of those things. And that's where, like you said, how you go from a 70 to gross margin all the way down to a single digit profit margin. Because certainly in a lot of other industries that you cover and you go, 77 to 70% gross margin, how big of a deal could that possibly be? But like I said, when so much of it is going into your branding, that's what ends up happening, because those aren't variable costs like we think would be. You have to continue to invest in your brands. So that's what's happened. The plan that they have put together seems to make sense. And so as a business, and this is maybe where things start to go a little bit divergent here in terms of our thoughts. As a business, I think they're doing the right things.
I think you made it pretty clear that you like the strategy that they're taking with the business. Let's pivot and talk about the stock, because we've talked about that before. You can love a business and management can be doing everything right, but the stock still maybe not be worth buying. Where's Estee Lauder stock right now based on the pricing of the business, potential profitability, turning it around, and what management's doing?
So right now it's about a $40 billion company, and forward earning estimates, which basically I'm leaning on Wall Street estimates here, so it's about 39 times forward earnings. At those numbers, that's really hard for me to justify as an individual shareholder or as an individual investor looking to allocate new capital. It currently has lower profit margins. There's an expectation they'll get better. It's going to take some time. And also it goes to show that it is a durable business, but it is not an immune business. It can still run into these bumps. And so in my opinion, that kind of knocks down what you would reasonably pay. I think it would be fair, and you can argue with me if you want, but I would say 20 times earnings is probably a reasonable expectation for a business like this.
Let's say 2014 to 2017, back when it was getting 80% gross margins and generating net margins of right around 10%, it traded for maybe 25 times earnings. The thing that's changed now is interest rates are much higher. So you need to get a better
Your expectations
multiple.
are higher. So
right.
Using that 20 times earnings, I was like, okay, what does it actually have to earn to be at 20 times earnings at this current market cap? And basically, to do that, it would have to have profits that are well in excess of what these we'll call bumper crops years were in 2021 too, where all that pent up Asian travel demand hit, all of that pent up global demand, I guess would be the better way of saying it. Anything to
So get
be
back to this roughly 3.2 billions that it earned over these 4 quarters, that
right
3.2 billion. A lot of these profits were
making
dollars
up
that
for
were
that.
not spent
Yeah.
here. So again, versus again, thinking about the longer term trajectory of business that was maybe more on track to be doing 2 billion, maybe a little more than $2 billion a year, assuming the gentle up and to the right that we all imagine in our brains.
I think there's a lot of risk priced in to coming back to a reasonable valuation for this company. And so based on that, I don't know if I want to be allocating any new money to this right now. Like I said, it's a durable enough business that I want to keep going with my existing position, but I can't say that I'm running up to buy shares based on management's plan.